Okay, let's jump right in.
Yeah.
Welcome to a deep dive. We take a stack of sources and basically cut straight to the crucial insights.
Right, forget the dense reports. We're really digging for the gold here.
And today's mission, it sounds simple, but it's actually pretty profound. We want to unpack why doing well with money isn't mainly about how smart you are.
Yeah, it's much more about something, well, something human. Your behavior.
Exactly. We're diving into this powerful idea that, our financial lives, they're shaped less by spreadsheets and formulas.
And much more by psychology. It's a deep dive into emotions, definitely our personal histories, those quirks that make us human.
And why they sometimes mess with our money.
Totally. The core premise here is that finance, well, it isn't really like physics, is it? There aren't these neat universal
No,
laws.
it's messy. It's nuanced. It's driven by feelings a lot of the time.
And understanding the psychology, it's not just for like big shot investors, it really impacts everyone, everywhere.
It touches on risk, confidence, and honestly, even happiness.
Yeah, so using the detailed observations and anecdotes from the material we've got, our goal today is basically to help you see these powerful, often invisible psychological forces.
How they're playing out in how you deal with money, how others deal with it.
Right, and hopefully give you a sharper lens, maybe make some more effective choices down the line.
Okay, so let's unpack this central idea first. Behavior trumps brains when it comes to your money.
That's the headline, isn't it? The sources, they really argue that your financial outcome, where you end up, it's determined far more by your habits, your reactions, your discipline.
Our behavior.
Yeah, much more than your raw intelligence or even, say, a fancy finance degree.
And they give us some really vivid stories to back this up. There's this one about an executive, right? A smart guy, presumably successful.
You'd think so.
He's in a hotel restaurant, and he, accidentally breaks a lamp, a $500 lamp.
Okay.
So the manager comes over, asks him to pay, which seems reasonable. But the executive, he dramatically pulls out $5,000 in cash,
Wow, $5,000.
throws it down and says something like, here's $5,000, now get out of my face.
Yeah.
And don't ever insult me like that again.
Yikes. I mean, that's just wild. It's a display of wealth, maybe, but it screams zero emotional control.
Totally. And a completely twisted view of money and status, right?
Absolutely. And the kicker from the sources. Years later, the same guy, bankrupt.
So being smart, having money, none of that saved him. His behavior, that impulsive, arrogant display, that inability to manage his emotions around money, that was his undoing.
Exactly. Now, let's flip that coin. Look at Ronald James Reed. His story is, well, it's almost legendary now.
Oh, yeah, the janitor.
The janitor and gas station attendant in Vermont, an American philanthropist and investor. But yeah, a janitor.
First in his family to even finish high school, right?
Right.
He had to hitchhike to get there sometimes. Not the person you picture building millions.
Not at all. Reed had no fancy degrees, no high-powered finance job, but what did he have? Patience, discipline, incredible consistency.
He just quietly saved, invested.
And let compounding do its thing. Over decades, his fortune came purely from those behavioral skills. Not a huge income, not brilliant market timing, just good behavior.
Putting those two stories side by side, it really forces you to think, doesn't it? The critical factor isn't the IQ points or the starting salary.
It's the mindset, the habits, it's behavior.
Yeah. And the sources make this interesting comparison. They look at medicine.
Right. Medicine's been transformed over the last century, hasn't it? Scientific discovery, moving away from old, sometimes, harmful ideas towards empirical laws.
We understand the body so much better. Global health outcomes are drastically improved.
But finance, investing, personal money management, we still see so much struggle, so much confusion. People make seemingly illogical choices constantly, even really smart people.
So why the difference?
Well, the argument is we treat money too much like physics. We're always looking for those universal, predictable laws.
Like it's a science experiment.
Exactly. When really, maybe we should treat it more like psychology. It's full of individual emotions, social influences, and just this fundamental human messiness that, frankly, a simple formula can't capture.
It's recognizing you're not just a number-crunching machine. You're a person with a history, with feelings.
Which actually brings us perfectly to the next crucial point. That history, your personal history, is incredibly powerful in shaping your money mindset.
It's pretty profound when you think about it. The sources argue that everyone's unique life experiences, they basically dictate your core beliefs about how the world works, and specifically how money works.
And your own lived experience. It always feels more real, more compelling than anything you just read in a book or heard from someone else. It's visceral.
They describe this tiny sliver effect, which I thought was great. Your personal financial life, maybe it's 30, 50, 70 years of experiences.
Which, in the grand scheme of global financial history, is minuscule, like 0.000000001% or something tiny.
Right. But that tiny sliver, that feels like 80% of what shapes your personal beliefs about money. It's the lens you see everything through.
And that's why equally smart people can look at the exact same financial situation and come to completely different conclusions. They've lived through different slivers.
Makes sense. Someone who grew up in poverty, maybe rationing every penny.
Their view on risk, on saving, on what security even means is going to be fundamentally different from someone whose parent was, say, a wealthy banker. Their internal programming is just miles apart.
Or imagine living through really high inflation, like in the 70s, seeing gas lines, feeling your paycheck shrink.
That emotional memory leaves a scar. You'll view inflation risk completely differently than someone who's only known low, stable prices for the last few decades.
And this shows the limits of just studying history, doesn't it? You can read about the Great Depression, understand the mechanics.
But you can't feel it. You can't feel the fear, the uncertainty, the desperation of watching everything disappear. Those emotional scars from lived experience, they shape behavior in ways a textbook just can't touch. Some lessons, you just have to experience them.
And there's research backing this up, too. They mentioned a 2006 study looked at 50 years of consumer financial data.
Yeah, and what they found was really striking, how willing someone was to take financial risks. It wasn't really tied to their intelligence or education or how financially savvy they seemed.
So what was it tied to?
Their personal history, the economic climate they grew up in, the shocks they personally experienced. The study basically concluded that your risk tolerance is partly just the dumb luck of when and where you were born.
Wow. Dumb luck. That's humbling.
Isn't it? But it makes sense. Think about someone like Bill Gross, the bond king. His huge celebrated career, it happened during this decades-long bull run for bonds, all driven by falling interest rates.
So to him, bonds looked like these amazing, safe, wealth-generating machines.
Exactly. But his father's generation, they might have lived through periods of high inflation that absolutely crushed bond values. To them, bonds might look like wealth incinerators.
Same exact asset, totally different perspective, all based on lived experience.
And this difference in perspective, it helps explain things that seem totally baffling from the outside, like why lower-income households often spend so much on lottery tickets.
Right. The sources mention it's like $412 a year on average, 4 times what higher-income groups spend.
And remember, something like 40% of Americans can't easily cover a $400 emergency. So these are often people who'd struggle with a small, unexpected bill.
Spending more than that on lottery tickets with almost impossible odds. On a spreadsheet, it looks crazy.
But if you look at it through their lens, through their personal experience, it starts to feel, well, maybe not rational, but reasonable to them.
How so?
Well, if you're living paycheck to paycheck, maybe you see no realistic way to ever save enough for a down payment or a real vacation or just getting ahead that lottery ticket.
Yeah.
It's not just about the tiny chance of winning.
It's something else.
It's paying for a tangible dream, as the source puts it. It's the only shot you feel you have, however small, to hold a physical piece of paper that represents accessing the good stuff that wealthier people seem to take for granted.
It buys hope for $1 or $2.
Exactly. For a moment, you don't have to agree it's the best financial decision, but you can understand the deep-seated human motivation behind it when you consider their reality, their lived experience.
And that's really the big takeaway here, isn't it? Money decisions aren't just math problems. They happen in the real world.
Yeah, influenced by our unique histories, our egos, our pride, marketing bombarding us, weird social pressures.
Yeah.
It all gets scrambled into our personal narrative around money.
And understanding that narrative, that's crucial to understanding the real engine of wealth, which isn't always what we think.
Right. Which brings us to compounding and time.
This gets talked about a lot, but I feel like people don't really get it. The sheer power of it.
It's hard to internalize. The sources use this amazing analogy about ice ages. For centuries, scientists figured these massive planet-covering ice sheets must have been caused by something huge, right? Some cataclysmic force.
Big results need big causes. Makes sense.
But the real reason, Milankovich's theory, it's way more subtle. It's these tiny, almost imperceptible wobbles in Earth's orbit and tilt over tens of thousands of years. So gentle you'd never notice them day to day.
Okay, so tiny wobbles.
Yeah.
How does that make ice ages?
Well, these small shifts mean slightly less sun hits certain parts of the Earth during summer. And here's where the compounding kicks in. A slightly cooler summer means a little bit of the winter snow doesn't melt.
Just a tiny bit survives.
Exactly. But that tiny patch of snow reflects more sunlight next year, making it just a tiny bit cooler again, meaning more snow survives the next summer.
Ah, I see. It builds on itself.
Precisely. Snow survives, reflects light, leads to more snow surviving. This compounds over thousands, millions of years, eventually creating miles-thick ice sheets. As the glaciologist quoted said, "It is not necessarily the amount of snow that causes ice sheets, but the fact that snow, however little, lasts."
Wow. Tremendous results don't require tremendous force, just consistency over time.
And that applies perfectly to money. Small, consistent growth fuels future growth in this way that just feels counterintuitive. The results become exponential, not linear.
And the perfect human example of this, Warren Buffett.
Of course, yes, he's an investing genius, no doubt. But the source material really hammers home the simplest, maybe most important fact about his fortune.
He started young, like really young.
He's been investing since he was a child, and look at the hypothetical they run. If Buffett had somehow earned his, $84.5 billion fortune today, but only started investing that amount when he turned 30,
Okay.
instead of building from near zero since childhood, his net worth today would be something like $11.9 million.
I mean, million, not billion.
$11.9 million versus $84.5 billion. That's like 99.9% less. His skill is legendary, yes, but the overwhelming majority of his wealth comes from that early base and the sheer staggering amount of time it had to compound.
His secret weapon is time.
It really is. It's even crazier when you compare him to someone like Jim Simons.
The quant guy, Renaissance Technologies.
Yeah, one of the most successful hedge funds ever. Annual returns of like 66% since 1988. Buffett's long-term average is around 22%. Simons is getting 3 times the annual return.
Okay, so Simons must be way richer then.
Nope, he's about 75% less rich than Buffett, around $21 billion versus Buffett's $84.5 billion.
How does that even work?
Because Simons only really hit his stride as an investor when he was 50. He's had less than half the time for those incredible returns to compound compared to Buffett. Duration matters enormously.
So it's not just the rate, it's the runway.
Exactly. The sources do this slightly ridiculous calculation. If Simons had earned his 66% return over Buffett's 70-year time span, his net worth would be some number with like 18 zeros. It's absurd, but it drives home the power of time.
It's just hard for our brains to grasp, isn't it? Compounding feels weird because we think linearly, like 8 plus 8 plus 8.
Right. We get addition. We don't intuitively grasp 8 times 8 times 8.
Got it.
Multiplication, exponential growth, that's why we underestimate it.
Like the hard drive storage example. From the 50s to 1990, storage grew by, under 300 megabytes?
Yeah. Then from 1990 to today, 100 million megabytes. Even the tech optimists totally underestimated that exponential curve.
Bill Gates himself, in 2004, questioned why anyone would need a whole gigabyte for email.
He was still thinking linearly, anchored in the past. You just never get used to how fast things can grow exponentially.
So compounding, incredibly powerful, but easily missed because it's counterintuitive. And to actually capture that power, you need something even more fundamental.
It's survival.
Survival, explain that.
Well, getting rich. Lots of people manage that, at least for a while. Staying rich. That's where almost everyone trips up. And the sources argue that staying rich is the far more important skill.
Getting versus staying. Okay.
Think back to the 1929 crash stories. Jesse Livermore made a fortune betting against the market, betting it would fall.
Right, he timed it perfectly.
But Abraham Dramansky, already a millionaire, got wiped out betting on the market continuing to rise just before the crash. Ruin.
Okay, so one winner, one loser in the crash itself.
But wait, fast forward just 4 years. Livermore, maybe puffed up with confidence from 29, starts making bigger, riskier bets, loses everything he made and more, ends up taking his own life. Dramansky just disappeared.
So both ultimately failed.
Exactly. Both were good at the getting rich part, but they were terrible at the staying rich part. And the material makes it clear this isn't just some Wall Street tragedy lesson. It applies to everyone trying to build wealth. Getting money is one thing. Keeping it is another beast entirely.
So if you had to boil financial success down to just one word based on this.
Survival. It's about avoiding ruin, staying in the game.
And this applies to companies too, right?
Absolutely. The data shows something like 40% of successful publicly traded companies eventually lose effectively all their value. Survival is critical for them too.
There's that quote from Michael Moritz at Sequoia Capital, the VC firm. Decades of success.
And he credits it to always being afraid of going out of business. They operate with a healthy dose of paranoia, assuming tomorrow won't just be a repeat of today. It's that only the paranoid survive mindset.
So how does survival connect back to compounding?
Because compounding needs time. That ice age, Buffett's billions, they didn't happen overnight. They need years, decades even. And you only get that time if you survive the inevitable storms.
The downturns, the crashes, the periods where everything feels like it's falling apart.
Precisely. You know, it's hard to study Buffett's exact stock picks and replicate his genius, but it's much easier and arguably more valuable to study what he didn't do.
Which was?
He didn't take risks that could wipe him out. He prioritized survival above all else.
This is where having cash or just a margin of safety comes in. You called it oxygen earlier.
Yeah, the sources use that term. Cash itself earns almost nothing, maybe 1% return these days. Seems pointless.
Right.
But if holding that 1% cash prevents you from being forced to sell your stocks during a 40% market crash just because you need money for bills, the real return on that cash wasn't 1%, it was immense. It saved you from disaster.
Preventing one desperate panic sale during chaos can do more for your lifetime wealth than picking dozens of winners in good times.
Absolutely. Compounding doesn't need spectacular, uninterrupted growth. It just needs good growth, sustained consistently, without major interruptions, especially through the messy periods. Survival ensures you're still standing to benefit from that consistency.
So survival isn't just playing defense. It's the essential platform that allows compounding to actually happen.
Couldn't have said it better myself. And achieving that survival, that staying power, it requires embracing uncertainty.
Okay, uncertainty. That sounds uncomfortable.
It is. But planning is vital, right? We all make financial plans. But the sources argue the most critical part of any plan is planning on the plan not going according to plan.
The old saying, you plan, God laughs.
Pretty much. Look back just 20 years. 9/11, the housing bubble bursting, the global financial crisis, the huge market rally after that, COVID. Whose financial plan from the year 2000 accurately predicted and accounted for all of that?
Nobody. Impossible.
Exactly. So a fragile plan needs everything to go just right. A robust plan, though, it builds in room for error.
What does room for error mean in practice?
It means your financial life isn't overly dependent on specific, narrow outcomes. Not needing the market to return exactly 8% every year. Not needing to get that specific raise or promotion on schedule.
It means you can still be okay. You can still survive, even if things go sideways. Market returns are lower, unexpected expenses pop up, you lose your job.
Yeah.
Life happens.
Right. And it feels counterintuitive, but sometimes destruction is actually part of long-term progress. Like how your brain prunes away connections as you get older, you lose half. But you actually get smarter, more efficient.
Failure in the short run, if you survive it, can strengthen the system.
Think of Walt Disney. His first animation studio went bankrupt. Many of his early beloved cartoons actually lost money initially. Success wasn't this smooth upward climb. It came despite, and maybe partly because of, those early failures and setbacks.
This ties into the idea of tail events, right?
Yes, exactly. Tail events are those outliers. The low probability things, 1 in 1,000, 1 in a million chances that often have the biggest impacts, both good and bad.
We tend to focus on the outcomes of these tails, but we forget how rare they actually are.
Venture capital is the obvious example. Most startups fail spectacularly, but the 1 or 2 massive hits, the positive tails, the Googles or Facebooks, they generate essentially all the returns for the entire VC fund.
But it's not just startups, is it?
No, it's just as true in the regular stock market. Data shows 40% of public companies eventually lose 70% or more of their value and never recover. And something like 93% of the total index returns come from just 7% of the companies that perform exceptionally well.
So most public companies are kind of duds.
In the long run, yeah. Even established companies fail surprisingly often. Over half of tech and telecom companies, more than 1 in 10 utilities, eventually lose almost all their value. Failure is incredibly common.
And how does this apply to us as investors?
Well, investor success is also often driven by how you behave during those rare, chaotic tail events, those few days or weeks, a decade when everyone else is, frankly, losing their minds.
Like that example of saving $1 a month for over a century?
Yeah, from 1900 to 2019, you had Sue, who just invested every single month through booms, busts, wars, everything. Then Jim, who tried to perfectly time getting out before recessions, and Tom, who was a bit slower on the timing.
And the economy was actually in recession about 22% of that time. A significant chunk.
Right. But Sue, who did nothing special except survive and stay invested during that 22% of chaos, she ended up with vastly more money than the market timers. It's like Napoleon's definition of military genius.
Doing the average thing when everyone else is going crazy.
Exactly. Just don't panic. Survive.
Jeff Bezos even talks about this at Amazon, right? Embracing failure.
He does. After the Fire Phone disaster, he famously said something like, "We are working on much bigger failures right now, and that's okay. Because the positive tails, the successes like AWS, more than make up for the losses from the negative ones. You need to be willing to fail and, crucially, survive those failures."
Which means being wrong is just normal, part of the process.
Totally normal. George Soros put it brilliantly. It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. You can be wrong half the time and still make a fortune if you manage the downside, if you survive the mistakes.
We beat ourselves up over mistakes. But maybe the masters are wrong just as often as we are. They just handle it better.
That's likely true. Which brings us back to room for error. It's the key. It's not just being conservative. It's buying endurance.
Endurance lets you survive the routine bumps and the unpredictable tail risks that could wipe you out.
And that endurance keeps you in the game long enough for compounding to work and gives you a shot at benefiting from those rare, unexpected positive tails.
Like the blackjack card counter analogy.
Yeah, perfect analogy. Card counters have a slight statistical edge, but it's not a guarantee. Their core strategy isn't predicting every card perfectly. It's risk management.
Betting less when the odds are slightly against them, more when they're slightly in favor.
Exactly. And crucially, they operate with humility. They don't know exactly what's coming next. They need a big enough bankroll, the source mentioned, 100 basic units, just to withstand the normal swings of bad luck without going broke.
You can never bet every chip you have. The world just isn't that consistently kind. You absolutely have to plan on your plan, not going according to plan.
And this is precisely why leverage, using borrowed money to invest, is so incredibly dangerous.
Because it magnifies everything.
It turns routine risks, things just not going quite perfectly, into potentially ruinous risks. Total wipeout. Rational math might show you could be richer using leverage if you survive the downturns.
But the cost of that downside is ruin. You're out of the game.
If you get wiped out like homeowners underwater in 2009 or Lehman Brothers, you're done. You can't participate when the market eventually recovers, when opportunity finally knocks again. You didn't survive.
So survival trumps potential optimization through leverage.
Almost always, for most people. The author mentions their personal strategy is kind of barbelled. Take calculated risks with one part of their money, like stocks.
And be utterly terrified and conservative with the other part, like holding cash.
Yeah, it sounds contradictory, but it's designed entirely for survival. The safe part ensures they can live through the downturns and stick around long enough for the risky part to potentially pay off.
Okay, that makes sense. And speaking of things that seem contradictory, let's talk about being rational versus being reasonable.
Ah, yes. This is where the psychology really comes to the forefront. The sources are pretty blunt about it.
What did I say?
Basically, you are a person, a complicated, sometimes screwed up, emotional person. You are not a spreadsheet.
Finally, someone admits it.
Huh.
It seems obvious, but finance often ignores it.
Totally. We should make purely rational, data-driven decisions with our money. That's the ideal. But that's just not how humans are wired to operate in the real world, especially under stress.
The fever analogy they used was really good here.
Wasn't it? Science knows fevers can be beneficial. This guy, Wagner Jareg, even won a Nobel Prize for using malaria-induced fevers to cure syphilis, proving the body uses fever to fight infection.
Right, evolution gave us fevers for a reason.
Yet universally, we see fevers as bad. We reach for the Tylenol almost immediately. Why?
Because they feel awful. They hurt.
Exactly. People don't want to hurt. The statistical scientific truth about fevers being potentially helpful is one thing, but human behavior prioritizes comfort, avoiding pain, feeling better now. A doctor has to cure the disease within what's tolerable for the patient.
So how does that apply to money?
Well, Is it statistically beneficial to hold on to your stocks during a 40% market crash? History says yes, usually. But will most people actually do that if they're in agony watching their life savings evaporate day after day?
Probably not without extreme emotional distress. Or maybe they just bail out at the bottom.
Right. Human behavior often overrides pure logic when significant pain or fear is involved. We're not robots.
Even the experts aren't robots. There's the story of Harry Markowitz.
The Nobel Prize winner. The guy who basically invented the math behind optimizing portfolios for rational returns versus risk modern portfolio theory.
So what did he do with his own retirement money?
He said he split it 50-50 between stocks and bonds, not because that mathematically maximized his expected returns, but because it would minimize future regret.
Minimize future regret. That's not in the textbooks.
Not in the math textbooks, no. But it makes perfect sense in real life, doesn't it? Financial decisions aren't made in a vacuum, they're social.
You make them sitting around dinner table with your spouse, thinking about your kids, maybe comparing yourself to your neighbor or your brother-in-law.
Exactly. You're influenced by people whose opinions matter to you, by your own internal anxieties. Investing has this huge social and emotional component that pure rationality misses.
Like the leverage math again. On paper, you could argue that taking extreme leverage, even if you get wiped out sometimes, might lead to higher wealth if you just instantly restart.
Mathematically rational? Maybe. But is it reasonable?
Absolutely not.
Yeah.
The source called it absurdly unreasonable. No normal person could emotionally handle watching their account go to zero and then immediately jumping back in with massive leverage. They'd be scarred. They'd quit.
Committing to a financial strategy, especially through tough times, requires being able to tolerate the emotional cost, not just understanding the spreadsheet logic.
This is where that advice, do what you love, actually gets some, quantifiable financial importance.
It sounds soft and fuzzy, right? But think about it. Doing work you find meaningful, or at least tolerable, might give you the endurance needed to stick with your saving and investing plan during the lean years or when the market is terrifying.
Because the historical odds of making money in stocks improve dramatically over longer periods. Daily, it's 50-50. Over 20 years, it's been 100% so far in the U.S.
So anything that helps you stay in the game, anything that helps you endure the bad times without abandoning your plan, actually puts those powerful long-term odds in your favor. Loving, or at least liking, your job can provide that grit.
The sources mention other behaviors that aren't strictly rational from a pure portfolio theory perspective, but might be reasonable for individuals, like home bias.
Yeah, investing primarily in companies based in your own country, even if global diversification might technically offer better risk-adjusted returns.
Why is that reasonable?
Well, investing requires a leap of faith, right? You're giving your hard-earned money to strangers running companies you don't fully understand. If investing in familiar domestic companies is what helps someone overcome that hurdle and actually start investing, maybe that's reasonable for them.
Or what about people who day trade or pick individual stocks with a small part of their money?
Statistically, the odds are heavily against most individuals succeeding at that. But, as investor Josh Brown apparently said, if doing that with a small defined amount scratches an itch and prevents you from constantly tinkering with your main long-term retirement portfolio,
Then maybe it's a reasonable outlet, protecting the core strategy.
potentially. Or think about Jack Bogle, the absolute champion of low-cost index funds, putting some of his own money into his son's higher-fee active fund. Not rational for maximizing his personal returns, certainly.
But perfectly reasonable from a father's perspective, supporting his son.
Exactly. All these examples just show that money decisions are so often made in the context of emotions, personal goals, family dynamics, psychological comfort. Not just cold, hard data. What works for you, what lets you sleep at night and stick with the plan. That's often the reasonable path, even if it's not perfectly rational.
And this more human perspective is really crucial when we look at using history as a guide for the future.
Right. History is vital, absolutely vital for context, for understanding patterns, for calibrating our expectations about what's possible or likely.
What?
But it is not a perfect map of the future, especially not in finance.
The sources caution against treating historians as prophets. Right. Relying too heavily on past data works okay if the underlying system is stable, maybe like in geology or basic physics.
But finance, it's constantly innovating, constantly changing. The rules, the players, the technologies, they evolve.
Think about retirement saving in the U.S. The 401k, which is the main savings vehicle for millions. It didn't even exist until 1978.
And the Roth IRA, that's from 1998. So historical data on American saving habits from, say, the 1950s or 60s? It's interesting, sure, but how relevant is it really to today's landscape? The whole structure is different.
Or venture capital, it barely existed in its modern form 25, 30 years ago.
Phil Knight, the founder of Nike, wrote about how incredibly hard it was finding funding back in the day. He basically said all he found were risk-averse gatekeepers with zero imagination. In other words, bankers.
Today's startup funding world is completely different. Using failure rates or funding data from the 70s to predict today seems pointless.
Exactly. Even Benjamin Graham, Buffett's mentor, the literal father of value investing, changed his mind late in life. He stopped advocating for detailed analysis of individual stocks
Why, after building his whole philosophy on it?
because the world had changed. He realized competition among investors got much fiercer. Technology made information instantly available to everyone, and the dominant industries shifted from predictable industrial companies to less predictable tech companies. What worked brilliantly for 40 years didn't necessarily work the same way later because the game itself had changed.
This brings up that phrase everyone mocks. It's different this time.
Yeah, it's often used, usually correctly, to dismiss hype during bubbles. But the world does genuinely change. John Templeton, who hated the phrase, even admitted it's probably different at least 20% of the time.
And Michael Batnick had that great counterphrase. Maybe the most dangerous words in investing are dismissing the possibility that it actually is different this time, assuming things will always revert to a historical mean that might no longer be relevant.
Right, and the tail events just reinforce this uncertainty. The Great Depression, World War II, 9/11, the 2008 crisis, COVID. These are unpredictable outliers that fundamentally reshape the path of history.
The correct lesson from being surprised by one of these isn't, okay, I see what went wrong. I won't make that specific mistake again.
No, the correct lesson, as the source puts it, is simply, the world is surprising. We need humility about predicting the future because it will surprise us again. Assuming otherwise is a failure of imagination.
Which is why understanding the difference between being rich and being wealthy is so critical for navigating these surprises.
Yes, this is a really key distinction they draw.
There's that paradox with spending.
Yeah.
You see someone driving a flashy Ferrari in LA, and your immediate thought is, wow, they must be rich.
But the sources mentioned that the valets parking those cars often realized many of the drivers weren't super wealthy. They were maybe mediocre successes who were spending a huge chunk of their income just to look rich in that car.
They looked rich, but probably weren't truly wealthy.
Bill Mann had that quote. There is no faster way to feel rich than to spend lots of money on really nice things. But the way to be rich is to spend money you have and to not spend money you don't have.
Which is good advice, but the sources say it doesn't go quite far enough.
Right. They take it a step further. The only way to actually be wealthy is to not spend the money you do have. That, I.S., the definition of wealth.
Wealth is what you don't see.
Exactly. It's the unspent savings, the investments quietly growing. Being rich might be having a high income or assets you can spend. Being wealthy is having unspent money, which creates options, security, independence.
But that leads to the question. If wealth is just unspent money sitting there, what's the point? Why bother saving?
It's a fair question. The sources suggest people often fall into three camps. Those who sage, those who feel they can't save, and those who don't think they need to save.
And the simple, maybe surprising truth they emphasize.
Building wealth has surprisingly little to do with your income level or even your investment returns. It has almost everything to do with your savings rate.
The gap. The gap between your ego, what you feel you need or deserve to spend, and your actual income. Wealth is built primarily in that gap.
Think about the energy efficiency analogy they used. The U.S. didn't just solve the 70s energy crisis by drilling for more oil everywhere. A huge part of the solution was becoming drastically more efficient.
Right, we use something like 60% less energy per dollar of GDP today than in 1950. Cars get double the mileage, buildings are better insulated.
We effectively grew our energy wealth by needing less energy, not just by finding more supply. And efficiency, driving a smaller car, insulating your attic that's largely within your control, finding massive new oil fields, much less predictable.
So saving is like financial efficiency.
Exactly. And you don't necessarily need a specific purchase goal, a house, a car to justify saving. You can, and perhaps should, save just for saving's sake.
Why?
Because saving is your primary hedge against life's inevitable, unpredictable surprises. It buys you control over your time and your options when things inevitably go wrong, or even when unexpected opportunities arise.
And that control over your time. that's becoming maybe the most valuable thing money can actually buy in the modern world.
That's what the sources argue is the highest dividend money pays. Independence.
The ability to wake up in the morning and decide what you want to do with your day, your week, your year, who you spend time with, what projects you work on, for how long. The freedom to change your mind.
It's priceless. And it's bought primarily by having enough unspent money, enough wealth to decouple your daily life from the immediate need for a paycheck.
The author shares that personal story about wanting to be an investment banker, right? For the money.
Yeah, got the prestigious internship, the whole deal. And quit after just 1 month.
Not because he hated the work itself.
No, he actually liked the work. But the complete lack of control over his time, the unpredictable, endless hours dictated by others, made him utterly miserable.
That's that psychological concept of reactance, isn't it? We resist being controlled, even if we might happily do the task on our own terms.
Exactly. Doing work you technically love, but on someone else's crushing, unpredictable schedule, it can feel just like doing something you hate. The lack of control poisons it.
There was another friend's story, too, the musician.
Oh yeah, the guy who quit his job with just $12,000 saved up to try being a full-time musician. He figured out he only needed a few gigs a month to cover his basic living costs.
And the point was?
The point was, that moment having enough saved, that $12K that bought him control over his time and allowed him to pursue his passion, that was the moment of true financial success, the real freedom. Not necessarily selling a company for millions later, but gaining control then.
It's interesting. The U.S. is the richest nation in history. Yet surveys consistently show pretty high levels of worry and stress, often higher than in much less wealthy countries, or even compared to the U.S. itself back in the less affluent 1950s.
What are we doing with all this wealth if it's not buying more peace of mind, more control over our lives? It's a paradox.
And when you ask people what actually brings them happiness, the surveys are clear.
Yeah, they value things like quality friendships, feeling like they belong, having unstructured time with their kids. Literally 0 people in one survey mentioned happiness coming from working super hard just to buy more stuff, or being wealthier than their peers, or choosing work based only on future earning power.
Yet people often chase wealth thinking it will bring admiration or signal success.
But there's another paradox there. Others often just use your wealth as their own benchmark or aspiration. They admire the fancy car itself, not necessarily you, the driver, the big house, the expensive watch. It might bring less genuine admiration than people imagine.
So if respect and admiration are actually the goal,
Humility, kindness, empathy, those are probably far more effective currencies than horsepower or square footage.
which leads us to maybe the hardest financial skill of all,
Getting the goalposts to start moving,
knowing when enough is enough.
it's incredibly difficult. Our society constantly pushes ambition, striving for more, bigger, better, which isn't inherently bad. But unchecked ambition, the inability to ever feel like you have enough, that can be financially ruinous.
Why ruinous?
Because it leads you to take risks with things that are, or should be, invaluable and non-negotiable.
Like what?
Like your reputation, your freedom, your independence, your family relationships, your friendships, being loved, your basic happiness. These things are priceless.
And chasing more money when you already have enough often means putting those priceless things on the line.
Exactly. Knowing when you have enough money to cover your needs and provide a comfortable buffer for wants and surprises is key. It allows you to consciously stop taking existential risks that could jeopardize the things that truly matter.
The Rajat Gupta story is such a stark example of this.
Yeah, former CEO of McKinsey, worth over $100 million, clearly had enough by any rational measure.
But he risked it all chasing more. Insider trading conviction, lost his fortune, his freedom for a time, his reputation completely destroyed.
And the reported takeaway from him afterwards was something astonishingly bleak, like don't get too attached to things like reputation or accomplishments.
Which the sources rightly call the worst possible lesson you could take from that.
Because your reputation, your freedom, your family, these things are invaluable. They are absolutely worth being attached to and protecting fiercely. Knowing when you have enough is the prerequisite for keeping them safe. It's about recognizing the point where the potential upside of more money is dwarfed by the potential downside risk to things far more important.
The sources dive a bit into the history of the American consumer to show how this moving goalpost problem got so entrenched.
Yeah, it's fascinating. After World War II, there was this fear of falling back into depression. So policies were enacted to intentionally keep interest rates low, make borrowing cheap, encourage people to buy homes, cars, appliances.
And consumer credit exploded, right. Rules loosened from the Depression era.
Massively. Household debt grew faster in the 1950s than even during the 2000s housing bubble. Plus, interest was tax deductible back then. Combine that with pent-up demand from the war, factories shifting back to consumer goods, jobs being created, you get this huge economic boom.
But crucially, for a few decades, that boom was pretty widely shared.
That's the key point. From roughly 1950 to 1980, the boom involved making the poor less poor. Average wages doubled, then doubled again. The gap between the rich and poor actually narrowed significantly. The top 1% share of income halved after taxes.
Real income gains were similar for the bottom 20% and the top 5% during that period.
Right. Equality extended to jobs, lifestyles too. More women entered the workforce. People drove similar cars, watched the same TVs, bought similar goods from catalogs. You could generally understand and relate to the lives of your neighbors and peers. The Joneses weren't living on a completely different planet.
But then things shifted.
Starting around the early 70s, maybe early 80s through the early 2000s, economic growth continued, but it became incredibly uneven. The income of the top 1% soared, while the income for the bottom 99% grew much, much slower, or even stagnated for many.
Yet the cultural expectations rooted in that more equal 50s-70s era persisted. People still felt they should be able to live a lifestyle similar to most Americans, even as the definition of that lifestyle was increasingly being set by the rapidly diverging top tier.
And the acceptance of debt to finance that lifestyle also persisted. This created what the source calls the big stretch.
Rising incomes for a small group inflated the aspirations for the vast majority whose incomes weren't keeping pace. Keeping up with the Joneses became much harder and more dangerous.
They give the example of Peter, with a median income trying desperately to match the lifestyle of Joe with a high income. Peter takes out huge mortgages, big car loans, runs up credit card debt, leaves his kids saddled with student loans, all to maintain the appearance of a lifestyle that's no longer the median reality.
You saw it in housing stats. Median new homes grew 50% larger despite flat median wages for decades. More bathrooms than occupants became common.
And overall debt-to-income ratio soared from around 60% in the early 70s to over 130% by 2007, just before the crash. And that debt burden was increasingly skewed towards lower and middle-income groups trying to bridge the gap.
Expectations move slower than facts. The idea of a broad, prosperous middle class with relatable lifestyles persisted for decades after the reality had shifted towards sharp inequality. It felt good when it was true, so it's hard to let go of.
This ties into another psychological bias, Daniel Gilbert's end of history illusion.
What's that?
It's the common illusion that our personal history has basically culminated in the person we are right now. We feel like we've finished developing, and the person we are today is the person we'll always be. We consistently underestimate how much our goals, values, and desires will change in the future.
Oh, okay. And how does that impact financial planning?
It makes genuine long-term planning incredibly difficult. How do you rigidly stick to a 40-year financial plan when the you who made that plan might want fundamentally different things out of life 10, 20, or 30 years later?
That's a really good point. So what's the solution?
There's no easy one, but a key suggestion is to avoid extreme financial plans at either end of the spectrum.
Like living on practically nothing, or working yourself to death for maximum income.
Exactly. The potential benefits of those extremes often wear off as you get older or your priorities change. But the downsides, the missed experiences, the burnout, the health costs can become enduring regrets.
So aim for balance instead.
Aiming for a reasonable balance at every point along your working life, moderate savings rate, decent amount of free time, a manageable commute, time for family and hobbies, increases your endurance. It makes you less likely to burn out or radically change course due to regret.
And endurance, as we said, is what allows compounding to work its magic over the long haul.
Right. And it also relates to sunk costs.
The sunk cost fallacy. Sticking with something just because you've already put time or money into it, even if it's no longer the best path forward.
Some costs are a devil when people inevitably change over time. They make your future self a prisoner of decisions made by your past self, a different person. The advice: embrace the idea of abandoning financial goals or plans made by a different you if they no longer fit who you are or what you want. Adopt a I have no sunk cost principle when looking forward.
Okay, that's a lot about planning and psychology. Let's shift to something often overlooked when people chase financial success: the unseen price tag.
Yes, investing often looks easy when you're just looking at historical charts. The S&P 500 goes up over time. Simple.
But living through it is different. Holding stocks long-term sounds straightforward until you actually experience a real market collapse. Watch your portfolio value get cut in half and feel that knot of fear in your stomach.
Successful investing demands a price. But it's not usually paid in dollars and cents directly. It's paid in enduring volatility, fear, doubt, uncertainty, and regret.
These are the real costs, aren't they? And they're easy to overlook or underestimate until you're facing them in real time.
And the inability or unwillingness to see this price up front, it tempts people to try and get something for nothing, to chase the market returns without being willing to pay the emotional toll.
Like trying to steal the car instead of buying it, as the analogy went. It rarely ends well.
Exactly. The sources frame market volatility, the fear, the doubt, the uncertainty, all of it as the price of admission. It's the fee you pay for the potential to earn market returns over the long run.
And generally, higher potential returns come with a higher price tag, right?
Often, yes. Think about stocks like Netflix or Monster Beverage, which had astronomical historical returns. But the price? Netflix traded below its previous high 94% of the time, Monster Beverage 95% of the time.
So to get those huge returns, you had to endure almost constant gut-wrenching volatility and doubt. That was the fee.
You have choices when faced with this price. You can accept it and pay it, endure the volatility. You can find an asset with a lower expected return, but also a lower price, like buying a reliable used car instead of a sports car. Or
You could try to avoid the price altogether. Try to get the returns without the volatility, steal the car.
and trying to avoid the price, trying to engineer away the natural volatility and uncertainty of markets often leads to paying double later on.
Like the Jack Welch era at GE.
Perfect example. GE became famous for meticulously massaging its earnings results to hit analyst expectations every single quarter, quarter after quarter. They created this illusion of incredibly smooth, predictable growth.
Shareholders loved it at the time. They got the perceived safety without paying the normal price of uncertainty.
But the bill came due eventually, didn't it? All those smoothed over bumps eventually erupted into massive losses and a collapse in the company's value and reputation. Trying to avoid the fee resulted in a much larger fine down the road. Fannie Mae and Freddie Mac did similar things, hiding risk to appear smooth.
So the psychological trick is key.
You have to view market volatility and uncertainty not as a fine, a penalty for doing something wrong that should be avoided at all costs, but as a fee, a necessary fee for admission to the potential long-term rewards of investing. If you see it as a fine, you'll always be trying to dodge it, and you'll likely miss out on the magic of compounding returns. Find the price you're willing to pay, understand it, and then pay it.
Okay, that makes sense. Finally, let's talk about the power of narratives and the danger of hubris.
Right. Learning clear lessons from complex financial events like bubbles, the dot-com crash, the housing crisis is really hard. Even years later, experts still debate the exact causes and who is really to blame. The narratives are contested.
And bubbles aren't always driven purely by long-term investors being irrational, are they?
Not necessarily. A short-term trader might be acting completely rationally for their specific time frame. They might chase upward momentum, buying assets at what look like crazy high valuations to a long-term investor simply because it's working now and they plan to get out before the music stops. Money chases returns.
The problems arise when people playing different games start influencing each other.
Exactly. Like a long-term buy-and-hold investor getting swept up in the excitement generated by short-term momentum traders and abandoning their strategy, or consumer spending getting driven by people trying to signal status to others who are, themselves, just trying to signal status back. You get caught in these feedback loops, playing someone else's game based on their narrative.
And there's that interesting point about pessimism. It just tends to sound smarter, doesn't it?
It really does. Pessimism often seems more intellectually rigorous, more sophisticated. It grabs more headlines, gets more attention. Optimism can seem naive or Pollyanna-ish in comparison.
But the sources distinguish between complacency and real optimism.
Right. Real optimism isn't just thinking everything will automatically be great. That's complacency, and it's dangerous. Real optimism is believing the odds of a good outcome are in your favor over the long run, despite knowing there will be setbacks, sometimes brutal ones.
It's based on the underlying belief that generally most people wake up trying to solve problems and make things a little better, and that collective effort compounds over time.
But pessimism persists and spreads easily. Why? Well, money is ubiquitous, so bad financial news affects almost everyone instantly. Progress, like compounding, is slow and often invisible day to day. But setbacks, like market crashes or scandals, are fast, dramatic, and make for better stories.
And it's easier to build a compelling, urgent narrative around recent negative events than around slow, grinding progress.
Plus, pessimists who just extrapolate current negative trends often miss a crucial human element. Problems incentivize solutions. People adapt, innovate. Remember the forecasts of peak oil just 15, 20 years ago?
Yeah, the idea that we were running out of oil imminently.
Pessimistic extrapolations missed how rising prices and new technology like fracking would unlock vast new reserves and dramatically increase production. Problems often contain the seeds of their own solutions because humans are resourceful when motivated.
And when stakes are really high and information is genuinely scarce or confusing, people become willing to believe almost anything, don't they?
Absolutely. Think about medieval medicine before the scientific method, or investors falling for elaborate Ponzi schemes like Bernie Madoff's. If there's even a tiny chance that someone's complex story or prediction could dramatically change your life for the better or worse, you'll listen, you'll grasp onto it, especially if you feel vulnerable.
This is where things like room for error, flexibility, and maintaining financial independence become crucial hedges against our own vulnerability to compelling but potentially misleading narratives.
Exactly. We all create these internal stories, these narratives, to make sense of a complex and uncertain world, often based on very limited information. And we tend to confuse fields where precision is possible, like NASA calculating a spacecraft's trajectory.
With fields where uncertainty reigns supreme, like predicting the economy or the stock market.
The alien over Times Square analogy from the source material really captured this. An alien visiting Times Square in, say, 2007 and then again in 2009 would see basically the same physical reality. Same bright lights, same crowds, same technology. They might conclude the economy was unchanged.
But they'd miss the invisible damage.
They'd completely miss the collapsed narrative. The shattered trust in the financial system, the fear, the changed beliefs about risk and homeownership, all the invisible psychological shifts that actually caused the worst recession in 80 years. The physical infrastructure was fine. The human story had broken.
And Daniel Kahneman's lesson comes back here again. When the world surprises you, when your narrative breaks.
The correct lesson isn't, okay, I understand that specific mistake now, I won't make it again. The better lesson is simply acknowledging, wow, the world is surprising. Maintaining humility about our ability to predict the future is absolutely key because narratives shift and unexpected tail events happen.
Okay, wow, that was a lot. Let's try to synthesize this, pull out the core actionable lessons.
All right, first, less ego, more wealth. Recognize that building wealth is often about managing the gap between your ego, what you want to spend to signal status, and your income. Wealth is what you don't spend.
Second, save for saving's sake. Don't always need a specific goal. Savings are your hedge against inevitable surprises and the primary way you buy control over your time and options.
Third, understand and define the real cost of success in investing, the volatility, the fear, the doubt, the regret, and be prepared to pay that price. See it as a necessary fee, not a penalty to be avoided.
Fourth, worship room for error. Build buffers into your financial life. Endurance, surviving the inevitable downturns, is what allows compounding to work its magic. Room for error provides that endurance.
Fifth, avoid extreme financial decisions. Extreme frugality or extreme workaholism often lead to regret as you change over time. Aiming for balance increases endurance and long-term satisfaction.
Sixth, recognize that independence, genuine control over your time and choices, is arguably the highest and most valuable dividend that money can actually pay. Prioritize that.
Seventh, good financial decisions for you are often reasonable, not just purely rational. Consider your own history, emotions, and ability to stick with a plan. What works in the real world for you matters more than what looks perfect on a spreadsheet.
Eighth, respect the roles of luck and risk. Focus intensely on what you can control, which is primarily your own behavior, your savings rate, your patience, your reactions to fear and greed.
Ninth, use history as a guide to understand patterns and possibilities, but not as a rigid map of the future. Recognize that structural changes and unpredictable tail events mean the future won't be an exact repeat of the past.
10th, clearly understand the difference between being rich, having income or assets to spend often visibly, and being wealthy, having unspent savings and investments that provide options and independence, often invisibly.
11th, be constantly wary of the moving goalpost, the tendency to always want more, and the end-of-history illusion that assumes your current self and desires are permanent. These make enough a difficult target.
12th, understand that money decisions are deeply influenced by your unique personal history, your emotions, and social dynamics like playing different games or keeping up with unattainable lifestyles driven by inequality.
And finally, 13th, while pessimism often sounds smarter and gets more attention, cultivate a real optimism, one that acknowledges setbacks and challenges, but maintains faith in favorable long-term odds, driven by human ingenuity, adaptation, and the slow grind of progress.
We've really peeled back the layers on this surprisingly human side of money today, haven't we?
We really have. It's so clear that our feelings, our past experiences, our relationships with others, they play just as big a role, maybe even bigger than any balance sheet or financial calculation.
So as you, our listener, reflect on your own financial journey and all these ideas we've discussed, maybe consider this final thought. What is your personal, genuine definition of enough?
Yeah, not based on what society dictates or what your neighbors seem to have or what marketing tells you you need, but what amount of wealth, what level of financial independence truly buys you that priceless dividend, the ability to live the life you want, when you want, with who you want, for as long as you want.
And flowing from that, are you truly willing to pay the emotional price required to pursue financial growth? Can you accept the inevitable volatility, the doubt, the fear, viewing it not as a fine or a punishment, but as the necessary fee for admission to potentially achieving that independence?
It's a lot to think about.
It really is. Thanks for joining us for this deep dive.